So let us continue. Classical support and resistance points. Order blocks. So we are trading what we call a code-driven market. And in a code-driven market, there are market makers, and these market makers, they quote the ask and bid prices. So you find in the Forex market what we call the spread. The spread is the difference between the ask and bid. So the offer price is the one that the market makers are willing to buy from you, and the bid price is what market makers are willing to sell to you. So our market is having liquidity, like it's highly liquid. If you enter an order, it will be filled immediately. But it's less transparent, as in that we cannot see what we call order books. So order books shows the number of orders that have been entered, like the buys and the sells, and from there you will know the investor's confidence. Oh, third. So from there you know the investor's confidence. And in what we call the order-driven markets, which are quite opposite from the code-driven markets, we have what we call order books. So in the stock markets, in the crypto markets, you find the order books. They're right there. You know the investor's confidence, so it is very easy for you to anticipate for the next level move. But for a code-driven market, we simply use the candlestick charts to do what we call technical analysis and combine with other fundamental factors to know the next move. So we have narrowed down these candlesticks and identified these areas where you would find smart money buying and selling, and we call them order blocks. So order blocks are basically specific candles or bars that, when properly viewed in institutional context, can highlight smart money buying and selling. So just go direct to the charts. So we had a downtrend right here. We had a downtrend, and before the market reversed, we had this last red candle, which had the Morse body, and immediately after this candle, the market reversed. And we are now very sure that within this last candle is where smart money, who are moving the market, closed their sell orders and opened new buys. So this can be reflected by the market trading through this last red candle, and this last red candle triggered a bullish move. Therefore, we call it a bullish order block. And we also have another order block here. And what we expect is that later on, as the market goes up, it will retrace back to return to retest this order block and then continue up. And there is where we'll be looking for an entry for us to take for a buy, yeah? And that is what we call return to order block liquidity. Here we had Euro USD. As it was falling, you would find the market coming back to retest another block and then going down. It came back to retest another block and then went down. The same here. And also as it was going up. So this was a view. So here we had another block retest, and it actually formed a W right here. And then as we reached this order block, we had this downtrend, and we had this very strong support area, and then the market went up from the equal highs, and then we had this retracement. So basically, as the market was rising and falling, it was coming back to retest this order blocks, and then we had a continuation going up, or we had a continuation going down. So the last red candle with the most body and an anticipated support area before the market reverses is what we call a bullish order block. And the last green candle with the most body on an anticipated support, resistance area before the market reverses is what we call a bearish order block. So we also had a bullish order block right here. So we also we wait for a reaction. When the market comes to an order block, we wait for a reaction for us to take a buy trade, or if it's an order, a bullish order, a bearish order blocks there, we wait for a reaction for us to sell. And if you look at this reaction, it did not form a swing for us to take a buy. So basically, we had this retest, and then it came down to this. And if you narrow down now to lower time frame, so this is the monthly time frame. On the weekly, you can find we actually had a W and an M. So we had this W, but then we had this M. And if you narrow down now to the daily, we had a long-term consolidation around this order block, and then the market went up. So for the market flow, we would take our buy trade right there. We went up, and then the market came back down to this area again. We went up, and it formed an area of resistance. Therefore, we had a downtrend going like that. So these reactions, if you waited for these reactions on the monthly time frame, it will be difficult for you to be to trade. But if you narrow it down to lower time frame, then you trade the market flow, like the short-term buys, the short-term sells, and this for us, the day trades and the swing trades. Like you can swing this, or you can day trade all of that, and then you would have this swing. So we had a bearish order block, a retest right there, and it formed a very good M. So we also have what we call the mitigation blocks. And on the mitigation blocks here, we'll be looking on how price reverses on an anticipated resistance level. Price formed the first swing. We had this reversal, and then we had a retracement, which did not come back to this high that was formed, the initial high, and then we had this downtrend. So around this retracement, people enter their buy orders. So market makers now know that these people are in the wrong direction of the trade, so they would have this retracement to this level here to allow them to see little loss and scratch out their trade. So therefore, this is a buyer's remorse area, and then you'll see a downtrend from there. So we, on the mitigation block, we'll be looking at the last red candle here prior to this swing, and we call that a bearish mitigation block. So we would wait for a reaction around this area for us to take a trade. And you find sometimes the M's that are formed on the 15 minutes time frame, they're formed as a mitigation block. They would have a mitigation block right there. So for a bullish mitigation block, we would have the last green candle right there, and we would wait for a reaction around this point for us to take a buy. And this is called seller's remorse area, because we'll be allowing the sellers who entered in the wrong direction of the trend to scratch out their trade. So this is called a bullish mitigation block. And we have what we call the breaker blocks now. So here we had an example of a mitigation block. So this was a bullish mitigation block here. And the market came back, retested it, and then we had a continuation up. We also had this was a bearish mitigation block. The market came and retested it, and then it went down. So we also have a breaker block, which is the same as the mitigation block. The only difference is that the initial high that was formed has been broken. So this swing that is produced around at this area breaks the initial high that has been formed. So the last red candle here becomes a bearish breaker. So around this buyer's remorse area is where we'll wait for a reaction for us to take a sell. And for a bullish breaker block, you would find the initial low that was formed has been broken, and therefore the market will come around the seller's remorse area. So the last green candle right there prior to the swing forms what we call a bullish breaker block. So here we had our breaker block right there, and the market retested it. We had a continuation down. So if you look at this, we had this swing, but this was the last swing prior to this move. So here is where we find our breaker block. So our breaker block was right there, and then the market went down. We have what we call the last step broken. We are talking of the order blocks as support and resistance points. So a break of the order block, right? Like what we had here, we would expect for the market to come and retest it and then continue down. So if this was a support, it now becomes a resistance. So this scenario now is what we call last step broken. In the order block context, we call it a last step broken. And basically the mitigation blocks, the breaker blocks are a last step broken feature. So here we had a bullish order block. We expect for the market to retest and then continue up, but then we had a break and then it came back to retest it and then had this downtrend. We also have propulsion blocks. And in the propulsion blocks, we are looking at the third order block as a propulsion block. As the market is going up, it came back and retested the first order block here. It came again and retested the second order block. Now this third order block becomes what we call a propulsion block. And if this retest occurs, we have what we call zero drawdown trade. Usually price moves away very quickly, very fast. The same as this example here. And we also have vacuum blocks. And in vacuum blocks, we are talking of the gaps that are created as a result of volatility event. So the gap forms a vacuum of liquidity directly related to an event. Basically, no orders are entered in that gap. So basically, no orders are in this gap. So first of all, would have to fill this gap. So market makers would have to fill this gap, and it depends on where the market maker cycle is. So if at all the dealer has to finish the market maker cycle and form a peak, he will do that and then come back later and fill this gap. And you'll find that the dealer is filling the gaps with sellers and then buyers, sellers, buyers, in order for this gap to have what we call fair value prices. And then later on, this becomes a vacuum block. And depending on where the market is going, you would find the market retesting this order block, and then we have a continuation there. And here we had another example on USDMXN. I remember I took a sell on this area. And then right on this point is where the market maker cycle was completed, and then we had a peak, and then later on the market came and retested this vacuum block, and then we had a continuation up. So there are basically no rules on how the market makers would fill these gaps on the time. So we have gaps maybe on the weekly time frame that will be, I mean, would fill after 2 years or 3 years. That can occur too. So there are no specific rules. Like if a gap occurs, then it will be filled after this number of this amount of time. There's no that. So SMT, smart money tool. On SMT, here we are talking of smart money action in correlated pairs. So we have what we call the dollar SMT divergence, and we also have the commodities SMT. The indices SMT divergence. We also have the commodities SMT divergence, which is for CRB index and the dollar index. So for the correlated SMT divergence here, we have Euro USD and GBP USD. So these are dollar pairs around an area of support, an area of resistance. You need to monitor this. You need to monitor these pairs around the anticipated area of reversal, so support area or resistance area. And you'd find sometimes one pair is forming a higher high and another is forming a lower high. And usually the one forming a lower high would have a move first. So this will move first and then this will come in late. So if this moves first, you would eventually know that Euro USD would come back to move later on. The same for an area of resistance, an area of support. You would find maybe Euro USD is forming a higher low, and this is forming a lower low. And you find Euro USD moving fast, and then later on you find GBP USD is moving. So if you find Euro USD has moved, then you know that GBP USD will also move. So for a pair that would form a higher low or a lower high, it would have a much greater move and a very small retracement as it's going down compared to the one that is forming a higher high or a lower low. The one that's forming a higher high or a lower low, it would have a small move and a very great retracement, and then you'll see the market is going down. So here we had, this is the dollar index forming lower low, and this is USD forming a lower high, and you find Euro USD moved much higher, had a very small retracement compared to the dollar index. So Euro USD also at the same time it was forming a high, and GBP USD also had a high at this time, and then we had this move. So this was SMT divergence based on correlated pairs on the dollar. We also have the CRB index and the dollar index. So the CRB index is used to monitor commodity prices such as gold and oil. So it has an inverse relationship with the dollar index. So if the CRB is moving up, the dollar will be moving down. So if the CRB will be forming this, the dollar will be forming that. And usually, CRB index tends to move a bit earlier and can warn of a possible long-term shift in trend on the dollar index. So CRB index is found on the TradingView platform. So we have learned on the patterns, on the support and resistance, the SMT divergence, and this all brings us to what we call the market structure. So the market starts a long-term move on areas of support and resistance. That is by forming equal highs or equal lows on the monthly and the weekly time frame. So you would find before the market moves up, before the market moves down, they form an area of support or an area of resistance, and then the market would move. So this is Euro USD monthly time frame. And the market structure, we are looking at the monthly and the weekly time frame when we are talking of the market structure. So you see, we had a downtrend here, and before the market reversed, it formed a support area, and then we had this uptrend. It came to this area, we had equal highs right there, so this was a resistance area. We had a downtrend, came back and bounced around there, moving support area, which is the 800 EMA, and then from there we had a change of trend. So a break of the market structure, as the market structure was bearish, and then it now became bullish. And then the market formed equal lows right there. And we had this uptrend, and then it formed equal highs. We had a downtrend, equal lows. We had an uptrend, equal highs, equal lows. So you would see as the market rises or falls, even here it formed equal highs and then went up. You would find that before rising, before falling, it will be forming these support areas or resistance areas. So in our analysis, when we're doing our analysis, the first thing that we need to do is to identify these areas with equal highs, equal lows in our time frame. Look and note for these clean highs and clean lows, and then you will identify the current market structure and trade along with it. So on the monthly and on the weekly is where we look on the market structure. And having known the market structure, it gives us what we call buyers for position traders. So monthly time frame, weekly time frame gives us buyers for position traders. And when a market structure is broken, the next target should be the next support or the next resistance point. Weekly market structure can give us a good market flow for the daily and hour 4 time frame. So on the daily and hour 4 time frame, we identify the market flow which is good for swing trading and day trading. When the bearish market structure is broken, the market structure will shift to bullish. The same, when the bullish market structure is broken, the market structure will shift to bearish. Expect for the market structure to be broken at a support or resistance level. So market flow now, what we trade. The hour 4 and the daily time frame gives us the market flow. A short-term swing buyer compared to what we have on the market structure on the monthly and the weekly time frame. So on the daily time frame, you'll see clear 3 levels going down, clear 3 levels going up. But depending on what the market structure is telling us, maybe the bearish move will be greater than the bullish move, or the bullish move will be greater than the bearish move. So here we had a bearish market structure on the Euro USD. And when you look at it, we had a bearish market flow which is greater than the bullish market flow. Like the dealer was maintaining these highs and breaking these lows as it's going down, retracing up, going down, retracing up, going down. So this is for a bearish market structure on the monthly. Now here, this was Euro USD bearish market structure. Now before changing, we had a long-term consolidation forming the supports, and then we had a change to bullish market structure. Now after the change, what happened on the daily time frame? We had very strong and very large bullish movements, and then the retracements here, which we usually take trades, were very small, and then before having the next move, it formed an area of support, and then we had the next move going up. And right here, price is around this area. We have a reset right today. So if the market structure is bearish, you'll find price will be breaking previous swing lows and maintaining swing highs. We have seen it on Euro USD. And that marks the end of market structure of price action. So you had a very, very, very bad internet. That's why you find yourself thinking that I'm very fast and maybe you don't understand, but you're not actually listening to what I say the whole time. So you need to go through it, reflect it with the charts, and then if you have any question, you can simply tell me. Okay.
Okay, sir.
So I'll send you the recordings as soon as they are converted. So
Okay.
we'll meet again later on.
Okay. Later today.
Yes.
Okay, sir. Thank you, sir.
Okay. Thank you for listening.